Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. This is the week ending January 30th, 2026, the end of the first month of the year, and it couldn't be more eventful. Both good news and bad news, things changing on a dime. I don't even know where to begin, but I will say that I am still risk off. And so I recognize that my lens, my brain is sort of fine tuned to see all the confirming evidence of being risk off right now. And there's plenty of it. So I'm going to try to sprinkle in some good news as well. I mean, I experienced some good news despite being risk off, as well as experiencing the bad news. All right, so what do I mean? Well, we had precious metals turn on a dime. We had plenty of earnings drama. We had policy drama. We had Federal Reserve drama. We had political drama. All of this is contributing to like this cloud. Actually, let's not call it a cloud. Let's just say this swirl that's going around, because it depends upon your perspective as to whether it's a cloud or it's opportunity. All right, so let's go ahead and dive right into the charts. As always, what I'm trying to do is give you a quick summary of what happened. And so much happened this week, I can't possibly get into too much detail on these things. So if something catches your interest, please, please, please go ahead, get on the internet and do some more research before you decide to buy or sell any of this. And I will also say that I love that you're here. Please subscribe if you haven't. Put comments, feedback down below so that the algorithm knows what's up, as well as share and like this content. All right, let's get right into the stories. All right, so here is a quick refresher. This is the percentage of stocks trading above their 50-day moving averages, what I like to call AT54 above the 50. As a quick reminder, this is why I'm bearish on the market as a whole, is that we had a double failure at the overbought threshold, which is 70%. So AT50 is overbought when it's above the 70% threshold, and when it fails to break through and instead comes down, that is bearish according to the AT50 trading rules. And look at this, the call that I made actually ended up being timely, almost straight down for all this entire week, except for Thursday, there was some relief. Now, AT50 is currently at 58.3%. And oh, wow, look at that. We got a real-time update. That's funny. I haven't seen this before. Okay, so if you were watching closely, the platform TradingView just changed AT50 to 60.6%. So now I have to change my narrative just a little bit. The slide this week still confirms my bearish call, but what I was just about to say is that I'm looking at this long tail, and actually let me zoom in so you can see it. You can see these bounces off of the intraday low, and now Friday's bounce is even more pronounced. This tells me that buyers are finally starting to get interested in the market. That means that while I'm still bearish and I'm still risk off, I'm going to be now more finely tuned to evidence that sellers are already exhausted. Okay, so hopefully that made sense. Wow, that's a rare sighting to see a system update. Let's see if we get some volatility in the other market breadth indicator, which is the percentage of stocks trading above their 200-day moving averages, which I call AT200. Let me go ahead and zoom in. You can see the same effect, right? These long tails and buyers stepping in. Overall, even though AT200 is now below these former peaks, I think it's fair to say that longer term is still looking good, still looking pretty bullish, just because this overall breakout from the previous downtrend still looks intact. So there's a lot of dichotomy in this market. So market breadth has two stories to tell, and you're going to see two stories when I go into these individual charts. For instance, let's go to the S&P 500. Let me change this to logarithmic view, and I'm going to have to zoom in here. Just as a quick reminder, the big story earlier this week was the Federal Reserve holding rates steady. I wrote an article on this in Inflation Watch. If you want to check out my opinion on what happened with the Fed, I won't repeat that. I also did a short. But it's curious to see on the intraday level, the market gapped up and then sold off the rest of the day. If you were to look at this, the 15-minute chart, you'll see that after the Federal Reserve's conference call started, things actually stabilized, but the selling resumed. But look at these extremely long tails. This means that there is a lot of eagerness in the market to buy dips still. And that runs counter to my claim that this is a risk off environment, because buyers are just eager to just buy all the downticks, and sellers are going to very quickly exhaust themselves if they can't break through this. And in fact, on Thursday, you could see that the dip was so low, it actually came close to the 50-day moving average. Now, if you recall back to the AT50, what it looked like, there is still a dichotomy here. There's a divergence. So while the overall index is hanging in there, underlying market breadth is telling a different story, and that there's some serious deterioration underneath. All right, same thing with the NASDAQ. In fact, the NASDAQ is even more dramatic. The NASDAQ shows less eagerness to buy the dips, buy the lows, and you can see two tests of the 50-day moving average on the NASDAQ. This is important to note, because if after two tests, the NASDAQ can go higher, then I really have to step off of the risk off call, because it means that the buyers are getting ready to take the NASDAQ to new all-time highs finally, or to break the all-time high here. And I didn't label it quite closely, but if you look at where I'm putting this dashed line, in fact, let's just go ahead and put in a line here so you can see this very clearly. What I want to show is that there are some games going on here with the former all-time high. So let me just draw a quick line there and check this out. I mean, you got to love the technicals sometimes. So this line I drew at the all-time closing high, and that was set way back in the end of October. And on Wednesday, this is Fed day. Remember how I said the S&P 500 gapped up and then sold off? So that seemed to confirm my risk-off posture. Well, look at what the NASDAQ did. It also gapped up on Wednesday, Fed day, and then sold off. But it still closed barely higher, but then sellers have taken it all the way back down to the 50-day moving average. To me, that confirms a double top. But like I said, if the NASDAQ can manage to close, let's just say above the intraday high from Friday, which would be 23,660, then all bets are off for the bears. But if the NASDAQ comes below its 50-day moving average again, it's all on for the bears at that point. Because again, like I was claiming when I went risk off, this constant pressure on the 50-day moving average tells me suggests that it's getting ready to make a big blowout to the downside. Anyway, all that to say, keep an eye on the technicals. I think that's going to matter the most, even though we're going through earnings season, and earnings can change things on a dime as well for individual stocks. Now, here is one of the keys for me, of course. As you all know, I'm a big fan of IWM, which is the ETF of small caps, iShares Russell 2000 ETF. It was hit the worst this week in terms of it was the main the main culprit in dragging down market breadth. After this all-time high, you can see sellers have just been taking profits since the previous week and all the way into this week. Even though I was risk off, I decided, you know what, just in case something does turn around this coming week, I'm going to try one more time to go for my standard weekly setup for IWM calls. I did a call spread this time because I don't think a bounce will be resolved. If it is coming, I don't think it'll be resolved in the coming week. It'll take 2 weeks. So that's the logic there. If this doesn't hold, actually the 20-day moving average really did not hold. So if selling continues, I fully expect a retest of the 50-day moving average, which at that point, of course, I would try another time to play for a bounce. Okay, that's all the indices. Now let's get into the individual stocks and ETFs. These are where the real dramatic stories are. Unless you're living under a rock, hopefully you know precious metals sold off big time. Now the overall headlines are suggesting that the sell-off happened because the president nominated Kevin Warsh to be the next Federal Reserve governor, and Warsh has a history of being hawkish. But we all know from the rhetoric, at least, that the president is very interested in having someone in charge who's going to guide interest rates down. So it's a very curious, conflicting, whatever you want to say, uh, dissonant, cognitive dissonant type of situation here, right? So I'm just paying attention to the technicals here. In my last short, when I talked about the Federal Reserve decision, I claimed that gold was ready for a pullback. And I'm actually quite surprised it happened today and in such dramatic fashion. GLD, ticker symbol GLD, fell, closed with a 10.3% loss. I believe it was down as much as 15%. And why did I think that? Look at this parabolic move. Let's again remember the dangers of a parabolic move. I've written about this over and over again. I'm going to have to write about it again. Look at this, just constant closing above the upper Bollinger Band. That's this black line. Remember, the Bollinger Band defines about, let's just call it about 80% of the price action around the 20-day moving average. So when it's constantly closing above that, that is extreme behavior. Now, it is representative of high buying interest, but it's still extreme. And on Thursday, we had an extreme, which was a gap really high and then sold off way down. In fact, it sold off down to like 470 and then bounced back up. So it gave the impression that a recovery was already underway. But because it closed above the upper Bollinger Band, I became even more convinced that a sell-off was on its way. Now, this was so dramatic. The panic and the fear was so palpable. Look at this high surge in volume. I had to give a trade a try. So what I did, and I'll put this in my blog in terms of the specific configuration, is I sold a put expiring, a monthly put expiring in February at the 400 strike. And then I bought a calendar call spread at the 500 strike with the short end expiring on February and the long end expiring April. Now you're asking, well, why in the world would I do that? Well, what I'm thinking is that this former all-time high should be support for whatever extended pullback is coming. If not, I am actually perfectly willing to buy and hold gold at around 400. I think that would be a gift. And then if I'm right that this is overdone, I'm thinking that at least in 2 months, GLD should be able to drift higher back to around this $500 level. That's the play that I'm making. It, of course, may be wrong, but at the core of this claim, of the core of my claim or my trade, is that this $400 level will hold, or roughly thereabouts. Or if it doesn't, I'm still going to be happy holding gold around this level or lower. I think it's a gift. Now, of course, gold has had an extremely high persistent run up, so an extended rest would be well within the norms of trading behavior. But let's see what happens. That's what I say, of course, but let's see what happens. Now, silver. Silver was the real big loser in all of this. Ticker symbol SLV. It closed down 28.5%. I mean, not even in my most extreme bearishness could I have expected a resolution of this parabolic move. In fact, silver, in my opinion, wasn't even as parabolic. It was very orderly, mostly on or below the Bollinger Band, and it never got nearly as high as gold did. But anyway, it got impacted. And I think at its lows, it was maybe, I don't know, about 35% down. To me, that is extreme of extremes. If I were a silver bull, if I were tracking silver more closely, I probably would have bought around that 70 level because I would have thought it was close enough to the 50-day moving average, but I wasn't looking at it closely enough. So now silver is back on my radar. I want to buy silver, but I'm going to be, since I already have a pretty substantial trade going on with gold, I'm going to be much slower to pull the trigger on silver, and I'll be looking for the standard technical tests of support and confirming support. If you don't know what those are, or if you're asking for very specifics, just go ahead and ask me down in the comments. Now, because there was an overall sell-off in precious metals, that carried over to commodities. Copper was one of them. Ticker symbol FCX. This is Freeport-McMoRan. It fell 7.5%. When I saw this gap down, I went ahead and just took profits on my position in FCX. It's pretty substantial. I wanted to just go ahead and lock that in, not to mention that it gives me a buffer for the trade that I made in gold and GLD, which is where I really want to be. I want to have ongoing positions in gold wherever I can. notice that my taking profits on FCX is not a bearish call. The uptrend is still intact. In fact, at the lows, check this out. FCX bounced perfectly off of its 20-day moving average. That's pointing upwards. The 50-day moving average and the 200-day moving average, the blue line, are all trending up. So if FCX happens to continue to sell off, I am going to be a buyer at these natural support levels for sure. If it rebounds from here, I'll just keep an eye on it and watch, and hopefully gold will move in tandem. All right. Now, like I said, risk off. I saw plenty of confirmation of my risk off position, but I did not expect such a calamity in Microsoft. I've talked about Microsoft before. I put a short up. I talked about the ugly chart. I talked about how I was ready to buy, to accumulate more shares on the sell-off. But, I feel sorry for anybody who got fooled by this run up into earnings. That was really bizarre given the sell-off, check out the overall topping pattern in Microsoft. This big bounce suggested that good news was coming in earnings. And now that Microsoft disappointed in earnings, and I think what happened is that people are afraid that Azure cloud growth is coming to a halt, or slowing down, or peaking, or plateauing, or whatever, that because there was so much trader capital invested going into here, any kind of bad news was bound to cause a big collapse, even though I didn't expect this kind of pullback. So Microsoft post earnings fell 10%. And then the sellers stepped right back in after a gap higher. They stepped right back in and took Microsoft down another almost 1%. So not so bad. But anyway, Microsoft just reconfirmed its topping action. So you see this curvature. In fact, you could just follow the 50-day moving average, which is defining the overall topping pattern in Microsoft. So now I just need to be patient. Even though I think the selling is way overdone, I'm going to be very careful, technically disciplined on picking my next spot to add to my Microsoft position. So for instance, what would a next spot be? I would wait until Microsoft makes a new post-earnings, closes above its post-earnings intraday high. That to me would feel more comfortable, except for the fact, of course, it would run into resistance from the pre-earnings low. So there's going to be some tension there. But at this point, I would prefer just to get the sellers washed out of this thing, and the sellers may not be completely washed out until this post-earnings gap from last year, last spring, gets completely closed. And so that's at about 395, 396. I obviously don't want that kind of loss in my position, but that's where I would feel more comfortable on a risk-reward basis adding to that position. Now, on the flip side, in fact, of all the big cap tech earnings this week, Microsoft was the lowest on my radar for being at risk. I thought Meta was the one most highly at risk, and I actually put in a play with an iron. I shorted I shorted a call spread and a put spread, thinking that at best Meta might just kind of linger around its pre-earnings price, but instead it shot higher. It got all the way up to a 10%. Was it a 10% gain? Yeah, 10% gain. But check this out. Technicals weighed in on Meta too. It stopped cold right here. You see this purple line? It stopped cold at the gap and crap to the new all-time high that happened last summer. You see how important these levels are? And guess what? That level was right at the former all-time high before then. People, pay attention to the technicals. Even if you're not a technical trader, just pay attention to them for context and additional reference. So, at this point, I can't be bearish on Meta because it's above the 200-day moving average. And yes, buyers may have overextended themselves. That was proven out with this 3% pullback in Meta. But I am not interested in trying to get cute, trying to short Meta for a one-day move. So like I said, this was the move that both these big cap tech stocks surprised me in their moves. Okay, so there's AI stories going on here. So of course, let me do some more AI related stuff. Amphenol Corporation, ticker symbol APH. It had a bad earnings. I think actually their earnings were fine. It's just, again, look at this. There was a lot of big expectations going into earnings with this huge run up, a run up that got parabolic. There was a 7% gain, went well above the upper Bollinger Band. So the company had to be almost perfect to satisfy anyone. And instead, it dropped right to the 50-day moving average, about a 12.2% post-earnings loss. I did get into day trade mode a little bit, swing trade mode a little bit. I bought right near the 50-day moving average because the earnings looked fine to me. I just thought that this was a natural pullback with expectations too high. And then I went ahead and sold the next day. And now I'm just going to wait and watch what happens with this stock, because this is one I am looking for an entry point for the long term at some point. Now, I said there was some good news. There wasn't all carnage under the hood of the market. Corning Incorporated, ticker symbol GLW, opened Tuesday with a huge news about Meta paying Corning $6 billion for fiber optic cable in its AI data centers. And I talked about my case for getting into Corning earlier. And given I'm risk off doesn't just mean being bearish and trying to short things. It also means when opportunity comes and presents huge profits, it's time to lock it in. And that's what I did here. It soared 16%, well above the upper Bollinger Band. In a risk off mode, I have to take the profits off the table, even though GLW has a nice uptrend going. You can see how steep it's been getting, right? So I'm still bullish on the stock. I'm not bearish, and I'm fully willing to buy when it hits a technical support level again. This is another trade where the technicals told me everything I needed to know, and it made this opportunity available to me. I'm going to constantly bang the table for keeping technicals in your toolkit. All right. Now, Caterpillar, ticker symbol CAT, reported earnings, and it was a good one. It went up 3.4% to a new all-time high. And the interesting thing is that I thought Caterpillar became an AI story because of all the construction equipment that's needed to build out the data centers that are needed to support AI buildouts. Well, the thing I learned new, I know this is not new news, but I learned it newly, is that Caterpillar has been doing gangbusters business on natural gas power generators that are mobile ones that are sold to data centers that are trying to get up and running fast and can't wait for the infrastructure in the community or the surrounding region to come up to speed to support the electricity that they need. And from the story that I read and heard, Caterpillar's competitors in this segment of power generation are sold out for years. So apparently Caterpillar has a long runway to be able to profit from this line of business. That makes Caterpillar not just a bullish AI trade, it makes it a core AI trade, and probably for the year, maybe longer. So I'll be looking for another technical point to buy Caterpillar. You can see Caterpillar is in a nice uptrend. It's behaving well on the uptrend. It bounced twice perfectly off a 50-day moving average support. Back here, it also bounced perfectly off 50-day moving average support. So you can bet the next time Caterpillar tests 50-day moving average support, I am going to be a buyer. But for now, I'm cool just waiting and relaxing because, again, I am in risk-off mode. Now, going back to software, Microsoft was the biggest story. But let's take a look at the iShares Expanded Tech-Software Sector ETF, ticker symbol IGV. You know, Microsoft helped IGV to collapse on Thursday. I think that was Thursday. Sorry, let me just check real quick. Yes, Microsoft collapsed on Thursday. So IGV, thanks to Microsoft, collapsed 4.9%. Sellers continued the pressure, 2.1% on Friday. It's now at a new, what is this? It's like a new 8-month low or something like that. Regardless, the bearishness continues on IGF. It's now in a bear market because it's more than 20% off of its all-time high. I've written about how this is my theme for the year, not to be shorting software stocks, but to look for beaten up software stocks to buy. And clearly the market wants to give me plenty of opportunity to buy. I've learned my lesson. Microsoft has told me to just slow my roll and be patient and be watchful and just pick my spots, right? So I have been picking some spots. I've done some quick trades, but now I need to slow things down even more. And that's because one of my core, what I've made now my core positions in my claim to be contrarian on software stocks is ServiceNow. Ticker symbol NOW. I was hoping that it could hold steady post earnings, but it did not. It fell 9.9% post earnings, more than wiped out all of my gains because I made a fortuitous purchase right near the bottom. It wiped out all my gains and then some. But fortunately, it held steady on Friday, so 0.2% gain. So I'm somewhat hopeful that the stock can stabilize because the earnings, at least the headline earnings, look fine to me. I just think that ServiceNow got caught up in the fear and panic that Microsoft generated throughout the software sector. And just check out this low here. ServiceNow has not been lower. What is this? Since, sorry, it's hard for me to read some of these indices sometimes. It hasn't been lower since, wow, November 2023. So it's looking extremely attractive to me. But I've already got a position. It's a small position, but I'm going to accumulate at some later time when the technicals look a little better for me. Now, there's some stocks that are also teetering. This Palantir is at the nexus of software and AI, and it is putting on a major top. I mean, I know Michael Burry made a big deal out of a short position that he put on back in November 3rd. So far, Michael Burry is winning the fight. And I've been showing the technicals even before his short about how Palantir seems to be topping out. Look, it's basically been stuck since last summer. That, number one, is a danger sign when a stock has had this kind of run up, right? Momentum is gone. Let's be clear. Momentum is gone. And now it's been putting on these topping patterns. It's no longer a head and shoulders. It's sort of like a triple top with a neck or a head in the middle of it. But regardless, everything is saying that this stock is being distributed, that people are slowly selling out their positions. And this breakdown below the 200-day moving average is the bearish confirmation that a top is in for Palantir. I don't know how long this top will last. Earnings are coming up next week. So if earnings turn people around, that'll be great for the stock. But I wouldn't touch it in terms of buying the stock until it can get into a better technical position, like above the 200-day moving average. Right now, the next key support line is this $142.34 level, which was the low. I did a post on this. This is almost back to last summer when there was a panic move out of Palantir. It put on a nice hammer, and it turned out to be a very nice tradable bottom for the next several weeks, in fact, few months, until it got to this last all-time high. So again, Palantir is not looking good, but I'm going to be I actually have now taken on a bigger interest in next week's earnings report. That's right on my radar. Another stock that snuck under the 200-day moving average, which has me worried, is Hood, ticker symbol HOOD for Robinhood Markets. It confirmed the 200-day moving average breakdown. You could see it. Let me zoom in right here. It sold off and closed twice below the 200-day moving average. And it's now at I'm just going to skip through this. It hasn't traded this low since last summer, August of 2025. And if I pull back, you can see a topping pattern starting to bake into Robinhood. And again, this has been a very strong stock, so there's a lot of air underneath. I am a big fan of Robinhood as a company, as a stock. So I have zero interest in trying to find a place to short it. But I do have it on my radar, and I keep watching it from week to week to week to see if the technicals tell me it's time to sneak in a position. But right now, technically, Robinhood is bearish. And that will make their next earnings report of even greater interest to me, particularly since it sold off at its last earnings report. It lost 10.8% and hasn't been the same since. That is another warning sign for the stock. All right. Let's take a look at some more carnage that confirmed for me the risk-off posture. I've talked enough about Booz Allen Hamilton Holding Corporation, ticker symbol BAH, so I won't go over the whole case, but I just wanted to point out that I was I went from expecting that I might have to chase Booz Allen a little bit on this bounce, on the post-earnings breakout, and then a bounce off 200-day support. And then I went to relief that I got out of this position ahead of earnings because the week opened up with bad news for the company. The Treasury canceled all contracts. Let me correct the spelling there. Canceled all contracts because of an insider in Booz Allen who had leaked IRS information, and he was convicted. I think he was convicted guilty, and the Treasury responded with this cancellation of contracts. Now, ironically, I think Booz does about $2 billion worth of revenue in business. So this cancellation is very small relative to their overall revenue. However, this news is very bad for reputation. So there's a lot of now reputational risk in Booz Allen. I'm still going to keep an eye on this one for a buy because at some point, who knows how long it'll take, this reputational risk will fade into the background. I guess the CFO resignation in December was a telltale sign earlier, but you can see the stock soared and had good earnings report. And I'm still focused on the fact that the president and CEO loaded up on shares way back in October. Now, if Booz Allen trades below this point again, then I'll have some caution. So again, I'm going to be patient. No need to rush into this one. Reputational risk has a way of just lingering and being an overhang for quite some time on a stock. Another stock that has snuck under its 200-day moving average, that's very speculative, is IonQ, ticker symbol IONQ. It is in confirmed bearish territory. It's confirmed in definitive fashion, a breakdown below the 200-day moving average. I call it definitive because there's also this converging resistance of the 50-day moving average, 20-day moving average, and 200-day moving average. So it's going to be very hard for the stock to break out above that without some big positive catalyst. It lost another 7.5% today, and for a price that it hasn't been since, guess what? Last summer in August. And let's take a look back. The danger here with IonQ, and it's a quantum computing stock, very speculative, is that there is no real anchor here in terms of valuation. So the technicals are going to be very important here. I've been a big fan of IonQ. In fact, it's the only quantum computing stock that I bother with. So I am keeping an eye on it to see when the next trade will happen. But I do think it's in danger of a bigger pullback if it doesn't get a great positive catalyst soon. Again, not interested in shorting it, but I am very cautious about trying to trade it again. Roblox, another stock that snuck under its 200-day moving average. In fact, this one will show you why the 200-day moving average can be such an important signal to respect on the bearish side. Roblox, ticker symbol RBLX, broke down below its 200-day moving average in November. It had a relief rally that stopped cold at the 200-day moving average, and it hasn't been the same since. This is a stock that I may have shorted if I were paying closer attention because the 20-day moving average is so steeply pointing down, as well as the 50-day moving average. You could see now that the 50-day moving average is stepping in as resistance. The stock had a nice bounce earlier in the month when there was this big rotation into beaten up stocks. Stopped cold. Again, technicals. It stopped cold, faded cold, off 50-day moving average resistance, and it hasn't been the same since. And today, sold off 13.2%. You can't get more confirmation that this stock has gotten bearish. I think earnings are coming up next week. I've been a fan of Roblox just as the company and its product because my kids played it, my son in particular. But now, if I pull back, it looks like Roblox may have made a major double top. That's not good. So this means that Roblox is going to be hard to be an investor in, but maybe it will open up some trades. But I would not touch this until earnings just to see what house they need to clean out, whether they can come up with some positive catalyst. So that's ticker symbol RBLX. All right, one more bad sign. That, again, confirmed for me that this week and probably for many days and perhaps a few more weeks to come to stay risk off. Ticker symbol TCPC. This is the BlackRock TCP Capital Corporation. It does private equity. I think it is, no, sorry, not private equity, private credit. And their net asset value declined 19%. That was a disclosure at the very beginning of the week, and TCPC fell promptly 13% to a new, I think it's a new all-time low. No, well, not an all-time low, but it's close to its pandemic lows. But you can see that TCPC hasn't been a good stock to invest in for a very long time. I mean, it rebounded very nicely from the pandemic lows and then stopped cold right here in 2021, back when tech stocks, around the time tech stocks also peaked out during the post-pandemic era, and it's been a downtrend ever since. And I always warn, that a stock that's consistently in long-term downtrends like this, unless you are really convicted about some fundamental catalyst, you're just taking a lot of risk trying to hang out for a long time. You have to have tight stops and good technical reasons for trying to bet on a bounce or a bottom. This stock has just been floundering and floundering and floundering, and then this, latest bad news just confirms this downtrend has a reason, and folks in the know are trying to get out of this stock. So that's TCPC. And now I'm even more interested in trying to track what's going on with private credit, because that was, I thought, one of the bullish stories earlier. All right. We're going down the last leg here. First Solar, I gave my case why I went ahead and took profits on First Solar. I didn't like this breakdown below the 50-day moving average. So far, I'm validated. First Solar broke down again, ticker symbol FSLR, broke down again on Thursday by 10.2%. So it is definitely confirmed it's in bearish territory, and a test on the 200-day moving average is in play. Now, I've talked enough about First Solar. I do want to get back into it at some point, but I'm going to be, again, patient and waiting for a good technical setup that suggests to me that the selling could be over, higher likelihood of being over. UNH, United Healthcare, ticker symbol UNH. This is one I've been trying to angle for a long-term investment. The stock just hasn't acted quite right. And once again, earlier this week, it cratered 19.6% on news that there'll be a minimal Medicare increase. They also released earnings that people weren't happy about. I thought this near 20% decline was overdoing it. And I'm really just hinging that on Berkshire Hathaway having purchased shares last summer. I'll be very curious to get an update on where their holdings are now. In the meantime, I'm assuming that they're still bullish on the name, and that's the only reason why I want to keep looking for a spot to buy for the long term. In the interim, because I thought this was overdone, I went ahead and sold a put. I was very happy to get a quick rebound the next day. 4% was enough to pretty much crush that put. I think it fell in value by 61%. I didn't want to press my luck, so I went ahead and took profits. And so far, that move is looking like a good one. It's reminding me why not pressing that rule about not pressing my luck works is the way to go. Sorry, it's not predictive. It's just that it's risk management. And the sellers have stepped right back into the stock. And so now these lows look in danger. You can see volume down here continues to be very high. All right, now for some good news again. I've made the case for investing in Stride Incorporated. It's an educational software company, ticker symbol LRN. It collapsed last earnings in October, 54%. People weren't happy that the company said that they had some, I think there were some contract issues and that they promised they were going to fix them, but the market's not trying to hear it. But when I saw that the company issued a $500 million stock repurchase program through October, I knew that meant they were going to be intensely buying their stock. I jumped in. And I actually accumulated stock one more time because the weakness that I saw afterwards, I just didn't believe. It's like people aren't paying attention. And the stock soared. So it reported earnings. And the aftermarket, the stock, I think, was up as much as 35%. I was so tempted to go ahead and lock in profits again. Because I'm risk off, I don't want to press my luck when big time profits make themselves available. But I decided to wait to see what would happen in the open. And I did not like the technicals of the open at all. The stock opened, I think it was about 25% higher. So that meant it's already fading from the aftermarket hours. Of course, I wouldn't have known that if I hadn't been paying attention, but it gave me the overall context of a stock that's being faded. And then I watched and watched and watched. It tried to hold support around at a 19% gain or so, I think it was. And then I looked intraday and I just did not like the look of it. So I just locked in my remaining profits. Now you can see this nice stabilization attempt. So it's possible that Stride is already bottomed out from the post-earnings fade. And that would be good because it would set up the new technical buying point. But if I do get back in at these levels, it'll be a much smaller position than I had before because I don't want to take as much risk um, um, with a bounce that's still on or above the upper Bollinger Band. All right. Thanks for hanging in there. Dollar Tree, ticker symbol DLTR is the last one. This is one where I took a little bit of a risk because I still have in my mind the CFO purchasing shares way back in last fall. I know the stock is well above that. I did take profits on my position up here somewhere. Turned out to be timely. The only reason why I took it is because it felt like the stock had run up pretty fast and it was now running into some stiff resistance from prior churn in from 2022 to 2024. So it just looked like a good place to take profits, and it turned out to be timely. And the stock fell straight down to 50-day moving average support. I decided to buy a small position. I was hoping that this support would hold, but again, the stock confirmed that risk off is really the meme, or sorry, the narrative of the week. And the sellers continued, confirmed the 50-day moving average breakdown, broke down below support from December's low, and that means that the stock is in bearish territory. I'm not interested in adding to the position again until some clear technical support shows up, and that might not be until the 200-day moving average around 105 or 106. All right, I know there was a lot, but a lot happened, and trust me, I only scratched the surface. Thanks for hanging in there. As I said earlier, if you want more content like this, go ahead and subscribe. Put your comments and feedback down below if you have any questions or anything else you'd like to see. And of course, like and share this content so that the algorithm knows what's up. Once again, thank you. I'm Dr. Duru from Ahan Analytics with the Market Breadth. See you the next time. Check out the blog, drduru.com/120.